I want to start off with the action that we've seen in terms of the so-called Magnificent Seven and its impact on the S&P more broadly. And we've got a chart here that really shows just how dependent the S&P 500's been on big tech. It's been testing that 200-day moving average again. Today we saw it close below 4,200 points. Is this a bit of a vulnerability for the S&P?
Very much so, because if you look at the year so far and you take the 493 stocks in there, they're flat to down for the year, and the 7 is up. If you look at the multiples of the 493, they're trading roughly at a PE average of 16 to 17. The big 7 were trading at 35 and going north. What we're seeing in the earnings season is that, yes, they do meet the expectation, but as indicated by Meta, as indicated by what we're probably going to see from Apple next week as well, is that the forward guidance is going to be slowing down. Why is it slowing down? The rate sensitivity, the consumer, which of course they're very much embedded with, and then just we got way ahead of ourselves on the AI component of the big 7. The AI is the future, there's no doubt about it, but there's never in history been a technology evolution where we adapted and worked out the benefits of the technology inside 1 year. We have already priced the next 50 years of AI into some of these stocks that needs to come down. So to some extent, it's very healthy what we're seeing right now.
Let's talk broadly about the tech sector, because now that we have surging yields, any small miss seems to be taken and investors seem to be punishing these stocks. Alphabet's fall of about 10% or so. How problematic can this be going forward?
Well, there's two ways to answer that question. If I've told you 12 months ago that the U.S. interest rate 10-year would be at 5%, the short-term interest rate at 6%, and told you that the big 7 and S&P overall would be up 10 to 15%, you would have thought I was starving mad. So it's kind of not a surprise that we see that reaction. What I think the market is now repricing, which is the second answer, is that higher for longer means that the input cost in terms of both capital and labor cost is going to go up, and these companies are very dependent on that. Even though they don't have a lot of debt on the balance sheet, you have to look at the forward cash flow and discount it back to today. Of course, it makes a huge difference whether that discount is happening at 2% or at 7 to 8%, or the working capital cost, which today in the U.S. is in excess of 10%. So it's really not necessarily because the companies are in a different place, but the value of the operation that they do from a monetary sense is coming down hard, and it's going to be repriced to that level in order to, again, stabilize.
Yeah, some saying that sell-off because of valuations is actually better than because of any business performance issues. But let's talk about the yields and them continuing to surge. Does this actually make sense, 10-year yields of 5% when you have the U.S. deficit also doubling?
It makes sense. The only thing that doesn't make sense is that we have a deficit that is exploding at a time where you have full employment from an economic angle. But in terms of the cost of capital, what the world come from is a COVID-related impulse of credit facilitation and, most importantly, a huge transfer from the government sector to the private sector. It happens during Trump's watch, and it was exacerbated by the sort of MMT angle that Biden decided to have. And now we have an out-of-control fiscal, not only picture today, but forward-looking picture as well. The market, in terms of market makers, do not have the capacity. The money market funds is saturated. The Social Security fund is saturated. The market is saturated. And everyone who's in the CTA space is short and on an autopilot to sell the market. However, Fed is done, RBA is done, ECB is done. So we are inside, in my opinion, 5 to 10 days, 5 to 2 weeks there in terms of when we're going to see the peak here. And more importantly, I think the odds of a illiquidity event to happen to the market is very high. I know for a fact that Fed is checking with market players about liquidity, about what the disorder that they see in the market. And as with the Bank of Japan, when the market becomes too high in terms of velocity, they get concerned. I think we are at that point. In other words, we are at that place we have been looking for in the last 6 or 9 months. If Fed continues to hike interest rates, something will break. Something is breaking.